Welcome to the Three Edge Week in Review for the week of November 7th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will discuss this past week's midterm elections and what the results could mean for the market and the economy going forward. And we'll also discuss Thursday's report on inflation and the market's enthusiastic rally in reaction to the report of the Consumer Price Index for October. So first, let's take a look at the still ongoing midterm elections. And I would have thought that, there was a good chance that, Steve, by the time we get to Friday, we'd know at least which party would control the House. But it seems likely Republicans will gain control of the House, but we'll need to wait a little longer on that. And in the Senate, it may be that maybe it gets decided in the next week or so, or it could come down to that runoff in December in Georgia. So as the TV says, the midterm elections are still too early to call. So, but we do know some things. So I guess my question is, based on what we do know and what we think could transpire there, what do you think the impact could be on the markets of the midterm elections?
Well, markets do prefer gridlock. And I think there's a good chance, even though the red wave never materialized, I think there's a good chance that the parties will be split. And so why do the markets like gridlock? Well, one reason is that the markets perceive there would be less of a chance of some major spending program that comes out that might have some unintended negative consequences to the economy and the markets. Second is that there might be less of a chance of business unfriendly regulations that newly get created. And if you have gridlock, if the Republicans control one of the Congress, either the House of Representatives or the Senate, then that might be sufficient to block new spending programs or new regulations. Now, one concern I would have, though, is with gridlock, we have something coming up next summer, and that is the debt ceiling would need to be extended. We'd be running out of the previous extension of the debt ceiling, and it's projected to be somewhere in July 2023. It could be plus or minus a month or two. But if sometimes in gridlock, there's such political grandstanding that you start to scare the markets that there could be a default, and that would be a negative.
Yeah, absolutely. So yeah, that probably you're right. That'll be something to keep our eye on. But let's shift gears now. And even though investors didn't really get what they wanted from the midterm elections, at least not yet, Thursday, the Bureau of Labor Statistics reported that year-over-year increase in the Consumer Price Index came in well below expectations. And this prompted a dramatic, at least one-day rally in stocks and in bonds. And we saw a material decline in the value of the US dollar. So I have a couple questions for you on this topic. So first, does this week provide evidence that, at least for now, Fed policy is more important to the markets than the results in the midterm elections? And my second question is this past week's CPI report, could it be that we have seen peak inflation now, and that who knows how long it will take to come down, but the Fed could be in a position to downshift at least the pace of monetary tightening? So is the Fed more important than DC in terms of the elections? And, could this be a real signal that finally we're starting to put inflation behind us?
Well, I think it's most helpful, Fritz, to consider that the inflation question and the elections are very interrelated. Yeah, it's really not two separate factors. They're very interrelated. And I want to demonstrate that by showing this chart. And this chart shows what you might think of as a vicious cycle or a self-reinforcing set of events that help explain what's happened so far. And then I want to show how the combination of the election and the inflation report could cause a break in this cycle. So for some time now, the economy and the markets, they've been overheated, as we know. And that eventually ended up in rising inflation beyond everyone's expectation. And so that'd be the top of the chart, and then moving in a clockwise fashion, fashion, that finally got the Fed to respond strongly, and they've had some of the sharpest rate hikes ever in history. That's the monetary tightening. What does that do? That helps raise interest rates, but also helps strengthen the dollar because they were moving much more aggressively than other central banks. And so that favored the US dollar as an attractive place to put your short-term money with rates going higher. With the prospect of a tight Fed, the dollar rising, rates going higher, that creates a situation where you have a monetary tightening that causes an economic slowdown, especially worldwide. You have tightening financial conditions, and then people are worried about economic slowdown. So then the governments worry about helping their voters and helping the citizens of their countries try to mitigate against the effects of an economic slowdown. And they've continued fiscal stimulus. They continued in many different ways, either to talk about tax cuts in some countries, or to talk about forgiving loans, or to talk about continuing some aspects of the stimulus programs, et cetera. And then that causes inflationary pressures to stay high because it creates artificial demand. Meanwhile, the governments, in enacting these fiscal policies, are not doing it with money that they've saved, but the governments are just borrowing more money, taking borrowed money to then offer the stimulus, and that causes the debt to go up. And with rising interest rates, that causes even more problems, and it means the government's going to have to even borrow more money just to pay the interest on the debt. And then that causes even further monetary tightening. So you have a Federal Reserve Board or central banks that are trying to tighten to bring inflation down. You have fiscal governments that are trying to do noble things to help people, but it's acting in the opposite direction of the Fed. And you have this vicious cycle that's just getting worse and worse. So where I want to talk about the election is that it's a chance to break the cycle where the fiscal stimulus might all of a sudden come to a halt if there's gridlock. Maybe big spending plans don't continue to be done, and that might cause a pause in the inflationary pressures. That might give the Fed an excuse to stop raising rates or to be very close to the end of rate hikes. That might make people think, well, maybe the dollar's not going to continue to soar, and it's time to take profits in the dollar. And when the dollar weakens, it acts as a loosening of financial conditions around the world. And then you worry less about an economic slowdown. So we could see a reversal of this this vicious cycle that's been holding the markets down.
Excellent. So as always, my final question tries to get at the investment implications, for the two things that we've discussed here, the midterm elections and the report on inflation and the investors' reaction to the report. So how should, based on what we've seen this week, how should investors be thinking about their investment portfolios at this point? Should they be thinking any differently?
So I think there are two important considerations to take into account given some of these potential changes. One, we'll talk about the U.S. stock market, and then two, we'll talk about stock markets outside the U.S. For the U.S. stock market, I think for now, the base case, it's still prudent to think the base case is that we are in a bear market. We know that bear markets have very strong bear market rallies. Yeah. And in this week, showed a great example of a big bear market rally. But as long as the market lives under its 200-day moving average, something we've discussed many times in the past, it's prudent to think, well, this could be a bear market rally. We're getting back to a 200-day moving average. We might stall out there. People who put money, at that point might stand to lose it and be punished if the bear market continues as the market hits the wall and then goes down and makes new lows. So there's still some caution warranted with U.S. stocks, I believe. On the other hand, with non-U.S. stocks, based on our measures, unlike the U.S. stocks, which are still overvalued, a lot of non-U.S. equity markets are either fairly valued or in some cases quite undervalued. And they've been suffering from the strong dollar. So if we get a sustained weakness in the dollar, if this is not just a 1 or 2 day wonder, but if we get a sustained weakness in the dollar, and if it really does become apparent that the Fed needs to back off their rate hikes. And one of the reasons could be that the 10-year Treasury has come down sufficiently where if they keep hiking rates, they're going to further invert the yield curve. And they might just decide, look, that we don't want to invert the yield curve anymore. That might act as a constraint on the Fed. Then the dollar could continue to weaken, and that could be a very powerful bullish sign for non-US stocks. So something that we should keep in mind. Also, if the US stock market does break through that 200-day moving average in a decisive way, then we have to consider that it could be a sign of a market getting a tremendous psychology boost and causing another mini bubble, still into overvalued territory, still not sustainable in the long term, but could last longer than we might think. So we should at least factor those two considerations while the base case is still we're in a bear market.
Excellent. Great. Thank you. Thank you for your insight. It'd be interesting to see how things develop from here, both in the midterm elections and on the inflation front. So that will do it for Steve and me for this week. As a reminder, all our videos always available on our 3Edge YouTube channel. And in addition, all our videos and all of our written commentaries are always available on our website, and that is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.